Today, I'd like to spend a few minutes talking about qualified small business stock, or QSBS, and Section 1202 of the Internal Revenue Code. The reason that I'd like to do that is it's a huge tax saving opportunity for any entrepreneur or business owner who's thinking about selling their business in the next 5 to 10 years or more. The reason is that if you can qualify for treatment as qualified small business stock, you're eligible for a minimum of $10 million of tax-free capital gains at the federal level. Here's why that's important. Let's say that you're someone who's considering selling their business and you have a $10 million capital gain upon when triggering that transaction. Realistically, most people will be selling their businesses in some combination of asset or stock sales. You'll pay tax based on a combination of income tax and long-term capital gains tax. Let's say that you have $10 million of long-term capital gains due when you sell your business. You'll pay 20% long-term capital gains tax to the feds on that transaction, plus the 3.8% extra Medicare tax, totaling 23.8%. If you multiply that by $10 million, that's $2.38 million going to the feds as a result of that transaction, meaning that you keep a little more than $7 million for yourself before any state or other taxes due on the transaction. Well, if your business and the stock of your business can qualify for this tax treatment, you get at minimum $10 million of tax-free capital gains, meaning that rather than paying $2.38 million to the IRS, you pay nothing. Now, there are caveats. You can't just fall out of bed and have this happen. Number one, your business must be organized as a C corporation. If it's not, you might have an opportunity to reorganize as a C corporation before selling. The caveat is that you have to hold the C corporation shares for at least 5 years. There's a minimum 5-year holding period here. On top of that, the owner of the shares must be either yourself as an individual or another pass-through entity like an LLC, or an estate or a trust. It cannot be another C corporation. So your business has to be organized as a C corporation. The holder of the shares cannot be incorporated. Now, on top of that, only certain businesses will qualify for this. Any service business where the primary asset are the skills and experience and reputation of one or more people, those do not count, unfortunately. That means medical practices, accounting firms, financial firms, banking, brokerage, architecture, engineering, none of those businesses can qualify for this tax treatment. In addition, the IRC explicitly disallows restaurants and hotels from this tax treatment too. Now, if you're a manufacturing or a technology or a software research and development type business, this could potentially be a good fit. And that's precisely why this kind of tax treatment is very common in the venture capital world. That's because those are the exact types of firms that venture capital funds often like to target. So you have to be a C corporation. The holder of the shares cannot be a C corporation. You have to be in certain lines of businesses, and the line of demarcation there is that 80% of your business must be in a qualified business, which is anything but those that I just listed. On top of that, this treatment is only applied to the original holder of the securities. So if you start your business, the C corporation that you just created gives you shares of stock. You can't gift or sell those shares to somebody else and have this same treatment work for them too. It's only the initial holder in most cases. That being said, the $10 million applies to as many related parties as exist. So a lot of people who do this would have the C corp issue shares to themselves, maybe their spouse, maybe even their kids. That's a possibility. As long as it's shares of stock, it doesn't matter whether it's voting or non-voting. It doesn't matter whether it's common or preferred shares. You have some discretion over how it's set up. But you have to be in the right business. On top of that, the business cannot have more than $50 million of assets either before or immediately following the issuance of shares. So there's a lot of rules here, but the benefits are massive if you're someone who has substantial equity in a business that you expect to sell. You don't need to remember all the details. Just know that this can provide a whole lot of tax savings if you do plan to exit at some point. And if you haven't discussed it already, I would suggest bringing this up to your accountant, bringing this up to your attorney, asking how this treatment might impact you and whether you can qualify. Because remember, if it requires a reorganization of some kind, you have to hold the stock for 5 years before you can qualify for this.